So, my plan is to complete chapter 9. We want to solve 2 problems and cover some concepts here. First of all, active management. And this chapter is about fixed income management, right? Bonds. So managers of passive portfolios would like to track the benchmark index perfectly. So perfectly means very, very small tracking error, right? In contrast, active managers deliberately deviate from the benchmark to enhance return. Now, there is a spectrum of active management. How active management or how actively a particular portfolio is managed. One is with enhanced indexes. Managers are allowed only modest tracking risk and focus on a small tilts, right? The small bias, the small changes in sector, coupon, maturity, credit quality, or issuer weightings, while retaining the requirement that the portfolio match more aggregated characteristics of the benchmark. Meaning, for fixed income portfolio, what is the most important factor? What have we been covering from this chapter a lot? What are those 2 things? One has something to do with how you can measure the change in bond price for change in interest rate. And I think our speakers also mentioned that a couple of times.
Duration.
Very good. Duration, right? Duration measures the percentage change in bond price, right? Or in your bond portfolio for change in interest rate, right? If the duration is 2%, then 1% change, parallel shift. Remember also that the yield curve can change in many different ways. One is shift, which means increase or decrease by the same amount in all maturities. Another is twist, which basically changes the slope. Another is butterfly, which actually where we see there is a kink, we call it. If you remember from the Excel spreadsheet we worked on last class. So this is our current yield curve. We are assuming it is a flat curve, but we usually do not have a flat curve. We usually do not have a flat yield curve. What is the most common yield curve we see in the economy? So what does the yield curve display? Interest rate at different maturities. So as an investor, if you want to invest in a longer term bond, do you expect higher return per period or lower return? Higher, right? So should you expect a flat yield curve, meaning same return each period for any maturity, or higher? So in that case, what will be the shape of the yield curve? Upward sloping, exactly right. But let's say it is a flat yield curve, so that I can show you clearly what it means by what is meant by shift, twist, and butterfly. I showed you in the last class, but it is not a bad idea to recap, right? Shift, let's say positive 1%. See, all maturities This is the maturity, right? It goes up by 1%. Negative 1% goes down by 1%. Now let's say get rid of the shift. What is twist? Let's say positive 1. So that means slope increases, right? If it is negative, slope decreases, right? Now let's get rid of slope, butterfly effect. Let's say 1. What happens here? This is that kink we are talking, right? So the middle term or intermediate bond, interest rate increases more, right? Relative to the shorter and longer end. This is positive butterfly effect minus the intermediate term yield decreases relative to the shorter end and longer end of the curve, right? Okay. So now they're saying active managers can manage a portfolio actively in many different ways. There are different levels of active management. When we are talking about enhanced index, it basically means we will not change at all or change very little the most important factors like duration. We will not change that, but we can change some other factors, which are sector allocation. Coupon can be little higher, lower, right? So we can change those, but we cannot change the most important factors, right? Which is duration under enhanced indexes. But if we are talking about full management, we can then change even the duration. We can even invest in a security which is not even in the benchmark, which is not even in our universe, right? So that is about full management. Okay. Now, when we actively manage a fixed income portfolio, we can employ different kinds of strategies, categories of strategies. One is interest rate anticipation, yield curve positioning, relative value spread bets, structure bets. We'll focus on the first two. Interest rate anticipation. So higher duration. So remember, one of the ways we can think of duration is the weighted average of the time until each cash flow will be received, right? So weighted average of time. Now, do shorter bonds have smaller duration or longer bonds have longer duration? Which types of bonds have longer duration? Shorter, short term, or long term? Long term, right? Okay. So that basically means longer term bond is riskier in terms of interest rate risk, right? Okay. So
Nine, 49, 49.
slide 49. Okay, thank you very much, Edward. So that's what we are saying. We need to increase duration when rates are likely to decline, because when rates decline, price goes up. And if we invest in a longer term bond, it will have longer duration, effect will be higher, right? and shorten duration when rates are likely to rise, right? Again, because they are inversely correlated. However, the level of interest rates is by far the biggest driver of fixed income returns. Remember those statistics when we talked about different types of move in interest rates? The shift, we are talking about shift, that accounts for 90%, right, of the changes in interest rates. The other two, twist and butterfly, 5% and then 2%. So yes, if we can correctly anticipate interest rate, that is great, but it is also the most difficult job, right? Very difficult to predict whether the interest rate will go up or interest rate will go down, at least in the short term. Very difficult, right? Okay. That was one strategy. If we know interest rate will increase, we will invest in shorter term bond. In other words, reduce duration. If we think interest rate will decrease, we will invest in longer term bonds. That means have higher duration or longer duration, right, for a portfolio. Another strategy is yield curve positioning. So under this strategy, we talk about barbells and bullets, and we talked about it briefly last class too, right? Barbells and bullets. A barbell of long and short maturities will generally outperform an equal duration intermediate maturity bullet bond if the yield curve flattens. Yield curve flattens means the slope decreases, right? So although then barbell and bullet, they have the same, let's say we are talking about one barbell and one bullet portfolio, they have the same duration. So the duration effect is same. But what is not same? Convexity. Remember, when we want to predict changes in bond price, we need to account for convexity too, right? And convexity is generally positive. And investors like convexity, that is why. So although these two bonds, barbell and bullet, they have the same duration, barbell will outperform if the yield curve flattens, goes down. Why? Because barbell have exposure to the longer term bond, right? Bullet has only exposure to the intermediate term bond. However, if the interest rate increases, meaning curve steepens, then our bullet will outperform, right? So here, under this strategy, we are focusing on the slope of the yield curve, right? Whether it flattens or steepens. Now, riding the yield curve. So riding the yield curve is the idea that as bond ages or its maturity decreases, say 5-year bond becomes a 4-year bond, and assuming the yield curve does not change, meaning, let's say, this is your maturity time, T, and this is your yield to maturity. And I will just plot a straight line to keep things simple. This is for 1 year. This is for 2 year. This is for 3 year. It is talking about 5 and 4 years. Four and 5. This is an upward sloping yield curve, right? Okay. So this curve represents if you invest in a 1-year bond per year, this is how much you will get. If you invest in a 2-year bond per year, this is how much you will get, right? As you invest in a longer term bond, your annual return is higher. Okay, and it has another name. What is it called? Term structure of interest rates, right? Term structure of interest rates. Now, what they are saying, writing the yield curve, let's say this is a very fixed yield curve. The shape doesn't change. Now, you bought the bond here. Now, let's say it doesn't give us any specific value for yield to maturity. I'll make up some number. Let's say yield to maturity here is 5%. Right? Now, after 1 year, the bond has a maturity of this. Isn't that right? Now, remember, yield to maturity, what does it represent? The annualized return, right? So, what do you expect the yield to maturity to be here? Lower. When the bond maturity goes down, right? So if its maturity goes down, yield to maturity has also go down, has went down. What would you expect to happen to the price? Up, right? So that is the strategy that we will buy a longer term bond and we'll sell when it has a shorter term. Let's say after 1 year, after 2 years. But the assumption here is yield curve shape does not change, right? And of course, that doesn't happen. Yield curve shape changes at least to some extent. Then we have to examine whether it is profitable to sell and at what time, right? But that is the idea that you invest in longer term bond and sell when its maturity has decreased and the prices went up. Another strategy, very similar, another example under this strategy is we buy less liquid bonds. So if a bond is less liquid, it means liquidity is a part of the risk. So if there is less liquidity, it is riskier for the investor. Isn't that right? So if it is riskier for the investor, will you expect higher return, higher yield to maturity, or lower? If there is less liquidity, it is more risky. If it is more risky, will you expect a higher or lower return? Higher, okay? Yield to maturity is higher for less liquid bond. If it is higher, what should happen to the price?
Higher is low, the price lower.
Exactly, right? Price should be lower. So under this strategy, then what you do? This lets managers systematically buy slightly longer maturities and sell them when they have shortened to more liquid maturities. Because from less liquid to more liquid, when it is more liquid, you expect lower return. Interest rate decreased, price went up. So it is also related to the idea of riding the yield curve, but it happens from a different exposure. It happens from the exposure of liquidity, not due to the exposure of directly lack of maturity. Yes, maturity has went down, but the effect is coming from liquidity because it doesn't apply in the same degree across all maturities. Some specific maturity bonds have this effect. For example, bonds with shorter maturities such as 2 years, 5 years, and 10 years trade at slightly lower yields than somewhat longer and shorter bonds. It is a pattern we observe, and there are many reasons why. Specific, one of the reasons is there is more demand in one maturity bond than another. Okay. Another strategy is credit risk. As the name suggests, what is credit risk? You will not be paid. As an investor, you will not get your money back. Default, very good. So a portfolio of corporate bonds is highly likely to outperform an otherwise identical portfolio of treasury securities. What are treasury securities? US government-backed debt, right? So we expect US government not to default. Although we had a discussion today, right, about the huge debt, $38 trillion, right? But it's still because US can actually print money, right? And so for everyone still values US dollar, right? So we generally expect US government will not default. So they don't have credit risk. But if we invest in a corporate bond, they have a credit risk. So risk is higher. We expect higher return. So that is what it is saying. Under this strategy, we just find out corporate bonds which are riskier than other bonds, right? Specifically, let's say corporate bonds over treasury. Okay, so I have covered some different strategies under active management. Now let us calculate the return from some active bond strategies. So this is probably less painful part for you. I know we already had an hour of lecture, so you probably want to do something that involves some effort, right? Movement of your body. So let's do it. Let's continue with our example. Go to active template. So what we are going to do, first of all, here is we have to examine the returns to the following bond strategy. What are those strategies? One is bullet. Bullet one, we will invest 100% long. What does long mean? Buy yourself? Buy. So we will buy. That means we will invest 100% of our money in this bond. 100% of our money in this bond. 100% of our money in this bond. What is changing? The maturity, right?
Yeah.
Now we have a barbell strategy also. That what does it do? A portfolio that is 49% long in this short bond and 51% long in this longer term bond, right? And it also says the duration of the portfolio is 1.96, the same as the March 2020 note. What basically this means, so you invest 49% in which bond?
In bullet.
Bullet one, and which has a duration. Okay, bullet one, let's say, I say bullet one plus 51%
Bullet three.
bullet three. So 49%. What is the duration of bullet one?
0.99.
0.99. What about bullet three?
2.89. 89.
2.89. Okay. Now go ahead and do that. You should get 1.96. So this is what it means, right? If you invest in this way, you will have a bond portfolio that will have the same duration as a single bond, which is an intermediate bond, right? Bullet two. So we should expect similar exposure coming from duration. That is what it means. So we do not have any exposure to the duration, right? In terms of differences in exposure between these two portfolios. But again, there are other things to consider, right? For example, convexity that can make things different. And we have also bullet 1 and bullet 3. So we are going to cover these strategies. And we will expect or we will analyze returns under each of these scenarios. Meaning, what if the yield curve decreases by 1% in all maturities, increases by 1% in all maturities. Slope of the curve decreases by 1%, right? And gradually increases by 1% slope, right? Twist means slope, and then butterfly. So these are our bonds. This is barbell. This is bullet 1, bullet 2, bullet 3. Preston, you have seen this before in your fixed income to some extent? To some extent, at least duration, convexity. Yeah. So now what we are going to do, this will come from our term structure. So I will highlight this. Pull down without formatting. These data are coming from our previous worksheet.
Why do we pull down?
Yeah, pull down without formatting.
Just pull
It's
that?
not,
Hmm?
Oh,
it's not working.
So you have this, right?
Yes.
Highlight and then pull down, and then without formatting.
oh. Okay.
What? Okay. Now what we are going to do, we are going to start with bullet 1. So this means what are the cash flows each year from bullet 1? What are the cash flows from a bond? The coupon, and at the maturity, the par value, right?
Mhm.
So enter equal. So this bullet 1 means this. This is a coupon. I will log divide by 2 because these are semi-annual, right? And we will start from here because this is today. The first coupon we get after 6 months. Multiply by which number?
Times the half for the 1,000.
Exactly, the par value. And I will log that too. And then how far can we go? Meaning pull across for this bond? Hmm?
September 9th.
2020?
What is the
29.
maturity of this bond?
29.
March 19, right?
19.
So only this 1 year, right? Do I have to make any other changes?
You gotta add the EV back.
Exactly. We have to add the par value, right? Here, right? Because this is the end of the bond. So plus the par value. So following the same strategy, do the same thing for bullet 2 and bullet 3.
Okay.
You see. Format one more time. The cash flow from bullet 1 is it +1? The cash flow. Then March 19.
You're talking about this one?
Say 1,015. I know you pull across and you add 1.
You want to see this formula, you mean?
Yeah.
Okay.
I just want to see, you add, okay.
What was maturity for bullet two?
6, okay.
Maturity is March 20.
Oh, it's, okay.
Yeah, because it is bullet 2. And then add the par value.
Okay. Okay.
Same for the other one?
Same for the other one, bullet 3. So pull across, and at the end, add the par value. Let's see, if I can make it bigger. All of you are squinting your eyes. So the last one I changed, I added the $1,000. Okay. Similarly, with this one. And on the next row, for each of these bonds, if you know, go ahead and calculate the present value using the interest rate from term structure. So here we are going to calculate present value. It is the same thing as
They should divide into,
say it again, me
the rate will divide into,
divide, or we can also multiply, raise it to the power negative exponent.
oh, okay.
Don't forget this minus if you are multiplying.
3.6.
Yeah, it's also 3.6.
3.6.
Which one?
The rate.
The rate.
Okay, so let us make sure you change all of this to 0.
Oh, okay, that's right.
Yeah, no, that's okay. I experimented with different rates.
We just change it and
Yeah, just
Start-
enter
start
0%, 0%, 0%.
Let me see. Yeah, any minus? Any minus? A minus? Minus active?
You're asking, is that a minus?
Yeah.
Yeah, this is a minus, yeah. Okay. Pull across. Now, here we are going to calculate the bond price, right? How do we calculate the bond price?
Some.
What should you have?
The sum of, I will actually select this entire block so that I can just copy paste down.
Present value says 15.03.
Which one, Edward?
So my present value,
Which present value?
present value for.
This one?
Okay, got it wrong.
Which one you got wrong?
The first present value.
This one?
The 995. Where is
So
it
do you
get?
have the same numbers here?
No,
Okay, so let's fix that. Do you have this number?
I got 15 point something. Yeah,
Let's see. So, would be 1 plus. Right, or you could do it actually, yeah, go
Yeah.
to the term.
so that the plus this one.
Mhm. Close,
Was a minus.
yeah, not minus, raise to the power minus.
Okay,
Yeah.
okay, I think that's
Raise it to the power
minus.
minus, and then choose that cell.
Okay, okay.
Yeah.
I think that's why.
Yeah, you can also sit in the front desk with me if you think it will be easier,
Yeah,
right?
okay.
Yeah, up to you. So, you have the card number now?
Yeah.
Pull across
Pull across, okay.
and then sum this entire block. And follow the same process for here. Now copy this formula. Paste as formula. Paste as formula. Does everyone have the same numbers?
Yeah.
Now, let's see if I can help you quickly.
Second.
So,
Bullet two.
we follow the same process, so that means you take the cash flow
Yeah.
times 1 plus the same interest rate. Is to be called minus, so yeah, just the same. Let's do this, and then we don't have to take every time. Two. Control C, paste as formulas. Paste as formulas. Right? There. So. Now, our barbell is 49% bullet 1, 51% bullet 3. So all we have to do, find barbell's cash flows, we have to multiply by these percentages. So this is our bullet 1. So for bullet 1, the percentage is 49%. I will log this. Multiplied by bullet 1 cash flow. Okay. This is bullet 3, which has 51% log times. This will be the total cash flows. Then, as before, we are going to calculate the present value. Yeah.
Used.
And then pull across. And we have to calculate the price. Copy this again. Paste as formulas. So these are the prices of our bonds, right? Now, and these are under a flat yield curve, right? So we have to change one at a time. Meaning not at a time. At a time means at the same time, right? One individually, right? We have to make those changes individually. So before we do that though, we want to bring these prices here so that we can copy paste the new prices easily. So copy, this will be equal to barbell, which is this one. Right? So that we can copy from the row to the row, right? Because we cannot copy from a column to a row. Now we are going to term structure. What is the first change?
Shift.
-1, right? Minus, so first change is so -1%. Now, these are our new bond prices, right? I will copy this. Control C. Actually, go ahead.
Can you redo it again?
Yeah.
So what everything?
So let's say actually I need that because before I change, I need to copy this. Control C and paste as values here.
Okay.
So that we are going to, because we are going to compare with them, right? Before the change. So these are our prices from these 4 different bond strategies before any changes in the yield curve. Now we are saying shift will decrease by 1%.
So just time structure.
Huh?
On the time structure, shift by -1%.
Yeah. Shift -1%, yes. So this will be our new bond price. Does everyone have this?
Let's see.
Yes.
Yeah. Okay.
1081, okay.
Control C, paste as values, of course, right? Similarly, make all of those changes. Now, instead of -1, +1. And just copy paste as values. Make sure you make it 0 before you go to twist. Make sure you make the shift 0 before you change the twist.
Let me see can I see the active template? Okay.
That's cool.
Now we are going to calculate the changes from here, right? Return. How do I calculate the pre versus post return? Or I should say post versus pre-return in this cell for barbell. What should I do? Yeah, very good. What is the new here?
1010.
Exactly, very good. So this minus what is the old?
990.
Very good. And I will log this, right? Log only the row so that I can pull across. Divided by old. Log only the old. Log only the row, I mean. Does everyone have 1.92? Okay,
Could you please show the form?
yeah.
Don't they have to be locked completely?
We want to pull across, right?
Yeah.
It's weird. I don't have the same number as yours, except the two first sheet. Can I see the term structure template? So whenever you change the rate, you change everything, right? Yeah.
Not everything.
No, you
Everything
just,
else needs to be zero.
yeah.
Let's see.
Oh, I understand why. Yeah, I got it.
You got
Yes,
it?
yes, thank
Okay.
you.
Mhm. So now you pull down without formatting, pull across without formatting. And this graph should be generated, right? So this is what you have to do for your homework, but let me discuss the output, right? Before I let you go.
Are you gonna post this one?
Yeah. So this output is on our slides too. So what do you see here? If you compare these two, or let's say compare these two, what do you see?
It's opposite.
Opposite. Okay. Very good, because it was only shift. Duration captures everything. Parallel shift. And so this is barbell, bullet 1, bullet 2, bullet 3. Interest rate decreased. So longer term bond should go up. Bullet 3 has the longest maturity. It has the best performance, right? Interest rate increased. Bullet 3 now has the lowest performance, largest negative, right? Now, what is interesting? What happened to our barbell and the bullet that has the same duration as the barbell? Here you will see, you cannot see the difference. Very, very small difference. But yeah, but because it is parallel shift, the difference is very, very small. The barbell outperforms the bullet with the same duration when the curve flattens. Negative twist. Here, we are talking about here now, twist. And why? Because barbell has exposure to the longer term bond. Isn't that right?
Yeah.
Because it is weighted average of short and long. So when the interest rate decreased, we had gain from the longer term bond. So bullet outperformed the same duration. Barbell outperformed the same duration bullet. Opposite happened when we had slope went upward. This underperformed the same duration bullet, right? So that's why they're saying barbell outperforms the bullet with the same duration when the curve flattens. Slope decreases. Opposite happens when the slope increases. Okay. Bullet 2 is the most sensitive to the butterfly movements. This is bullet 2. Highest gain, highest loss. And can you remember why? What happened in the butterfly effect? What did you change? So butterfly changed which interest rate more?
Medium, right?
Exactly, intermediate. Isn't that right? And in our example, intermediate is this bond.
Yeah.
Right? So when the interest rate decreased for the midterm bond, intermediate bond, more than the short end and long end on two sides, on the two wings, that's why it is called butterfly. The barbell, the bullet outperformed the barbell, right? Because midterm interest rate decreased more than the short and long. Opposite happened in positive butterfly, meaning midterm intermediate bond yield increased more than the short and long end of the yield curve. Okay. So, all right, guys, review this so that you understand why, under what conditions we need different types of bond strategies: short, long, intermediate, or maybe a barbell, including both short and long. Okay. All right, I will see you on Thursday. Have a good weekend.
Can you post this one?
Yes, I will.
Thank you.